Birkenstock shares sliding once again on the second day of trading after its disappointing public debut. The lackluster performance adding on to an already shaky IPO market. Other recent public debuts like ARM and Instacart have been struggling since their offerings. Here with more on the path forward for the IPO market is Kyle Stanford, PitchBook U.S. Venture Capital lead analyst, and University of Florida professor Jay Ritter, who also keeps a close eye on this market. Guys, thank you so much for being here. It has been a very interesting couple of months on this front. Kyle, I'll start with you. When you look at, Birkenstock sort of stood out even more than some of the other lackluster IPOs as of late because of the pricing and then the action. What sort of takeaways do you have from that?
Yeah, I think in reality, right, when you look at what's happened with the recent IPOs, it has not been the performance that anyone has wanted, right? There's still a lot of uncertainty in the public markets. Obviously with everything happening in Israel and still in Ukraine and the tensions between China, those are just adding more uncertainty to the market, and these companies that are coming to with these IPOs are just not finding the interest that they were hoping for. We track the Instacarts and the Klaviyo's much tighter than we look at the Birkenstocks, and those too, right? They turned profitability, they turned where they thought investors were looking for, and they still have not performed well. So it doesn't bode well for the rest of 4Q or even early 2024.
And so, Jay, let me turn to you. When you look at these names that have made their debuts, so ARM, Instacart, Klaviyo, now Birkenstock, in trying to explain the kind of lack of appetite here, Barron's said this, Jay, and I want to get your reaction to this. Barron's trying to make sense of all of this, says one issue could be that the advisors don't have a good understanding of how these companies should be valued. Barron's goes on to say they've misjudged the advisors' current market conditions. What's your reaction to that, Jay?
I think a big issue has been the reset in valuations for growth companies. In 20 and 21, we had the big run-up in a lot of growth company share prices. 2022, a big reset where, largely due to rising interest rates, investors started assigning lower multiples. And then with individual companies, analysts, investors have to figure out what is the potential growth of profits for this company. With young tech companies, typically that future growth is a really important part of their valuation measure. With a company like Birkenstock, which is much more mature, there's less uncertainty, but there's still uncertainty about its ability to grow future profits.
Well, and what's interesting here as well, Jay, about Birkenstock in particular is that it does actually make profits, which is not necessarily a given for companies that are entering public life. At one point, when you talked about sort of the go-go days of 20 and 21, it didn't seem to matter. Then it seemed to matter again, whether companies made money. But now you're saying we're really getting another change to wanting to see that steady growth of profits. Is that going to mean we're not going to see as many companies come public, for example?
Well, I think we're going to continue to see slow IPO volume for another year or more. After the big drop in 2022, in the past, it's frequently taken several years before IPO volume has recovered to average levels. And I think we're in one of these multi-year periods where it's taking IPO volume to recover over a multi-year period. But even though Birkenstock and ARM are profitable, there's still questions about how much can they grow future profits. ARM is selling at a pretty high price-earnings ratio where investors can only justify that by assuming that it's not only profitable now, but it'll be able to grow profits substantially.
And Kyle, what interests me too is just that we find ourselves in a different environment here where for the first time in a long time, there are alternatives for investors they can duck into T-bills, they can move into money market funds yielding 5%. How does that also kind of impact and influence the IPO market and risk appetite?
It definitely impacts it, right? Especially when you talk about these VC-backed companies that are supposed to be high growth, have really high valuations. They're much more risky investment for the near term and the long term than some of these other, T-bills, like you mentioned. There's a, much bigger appetite for those, for hang out on those for 2 years and then come back and see where the market's at. But right now, these high-risk tech growth stocks and IPOs are very, are not receiving the interest, obviously, that many were hoping.
And Kyle, when we look at the pipeline, if you will, of companies that are sort of getting close to IPO, or some of them we've been talking about for several years, what does private market financing look like right now? Will some of these companies be able to just continue on as private companies without having to tap the public markets?
Yeah, so this is actually a really big problem right now for late stage and venture growth stage companies. The capital availability in the private markets is just not there like it was 2 years ago. And so it's going to be really difficult for this stage, or the companies at this stage, to continue operating as private companies. 2 years ago, hedge funds, mutual funds, private equity firms were very active in this space, and they were pumping in a lot of dollars. And now that those dollars have moved back to their more traditional strategies, the capital that is available for late stage and venture growth. And I want to mention that those two stages have now doubled in the number of companies that are still private within them in the last 8 years. And so there's a huge number of companies that need capital. Without the IPO markets, without the capital availability in the late stage, it's a really difficult market for these companies.
And Jay, I want to end here with you on this. So we're talking about a lot of different headwinds and challenges for the IPO market. What about, Jay, also just this enormous pool of startup employees who are out there? And, Jay, they are waiting for this liquidity event. And if it's not going to be an acquisition, they're waiting for an IPO. They have life costs like everybody else. How much of a tailwind is that for the IPO market, do you think?
It's something that's definitely a factor. There are some liquidity options like NASDAQ private markets for typically venture capital-backed private companies, but that's certainly not the same level of liquidity that you get as a public company, either having gone public through an IPO or direct listing, or the last year and a half, quite a few companies have gone public by merging with a SPAC. That avenue for going public, however, is slowing down, and I expect it will continue to slow down substantially even as the traditional IPO market recovers.
Kyle Stanford and Professor Jay Ritter, thank you both so much for your time today.
Yeah, thank you.
You're welcome.